A lot of people who are retired get really worried about investing their money. This is because the markets can be very unpredictable and there is a lot of uncertainty about what will happen in 2026. However, when people learn about the way to invest and see the facts, they start to feel better and they invest their money without being scared. Now we will explain why this happens. First, let us talk about the thing that everybody is thinking about. A lot of people believe the market is going to have big problems in 2026. You see headlines about the market going down, the risk of inflation, and the economy slowing down. And that really worries people who are retired from their jobs. The market and its possible crash in 2026 is what is on everybody's mind. The truth is that market downturns happen all the time. People who are retired for a time should pay attention to the overall trend and the basics of the market, not what is happening in the news every day. They should focus on the trend and the fundamentals of the market because that is what really matters for long-term retirees, and not the daily news cycles that can be scary and confusing. Market downturns are a part of the market, so long-term retirees should not worry too much about them and should keep an eye on the trend and the fundamentals of the market. When people stop working and see how their money grows over time, they feel better. This is because their investments are spread out, so when things go down, they do not lose everything. The market usually gets bigger over years, even when it has some bad times. People who have stopped working can see that the market grows over time, and that helps them to calm down about their money. The market tends to grow over decades, even after it has some corrections. Retirees are changing the way they think about money. They are moving away from being scared, worried about their investments. Now retirees are looking at the facts and figures when they make decisions about their money. This is what we mean by retirees shifting from fear-based thinking to data-based investing. Retirees are using data-based investing to make choices about their retirement savings. Here are some things that a lot of people do when they retire. They know what is going on. Diversification of assets, like stocks, bonds, and safe income. I think it is good to stay invested for a time. This way you do not have to worry about when to buy or sell. Staying invested term is what works for me. You see, staying invested term means you do not try to time the market. Rebalancing regularly to lock in gains and manage risk. Focusing on yield and income in retirement portfolios. People who retired in 2025 were really nervous. Then, they looked at what happened in the past, especially after recessions. Retirees became confident after seeing performance. Historical performance of markets is really important. Markets always grow after a lot of volatility. People often forget that markets can recover and grow after being really volatile. Retirees need to remember that markets can recover and grow. These examples show us data that backs up the idea that worry is not helpful. We can see that worry does not do us any good. The examples are using data to prove that worry is not useful. This is what the data on worry is telling us. If you are a retiree or you are planning for retirement, do not panic. You should make a plan that is based on information and facts, not what you read in the news. Remember this, the markets for things like stocks will go up and then they will go down. But if you put your money in things for a long time, and you stay patient, then long-term investing with your retirement money is a good thing, and it will work out well for you when you stay patient with your retirement investments. Thanks for watching. Hit subscribe for more investing insights.